You ever look at your paycheck, see how much tax is taken out, and just wonder, how is it possible that the wealthiest people on the planet can legally pay little to no income tax, while the rest of us see a huge chunk just disappear? Well, today, we're pulling back the curtain on their exact playbook.
And look, this isn't some kind of conspiracy theory, it's all out in the open. Public records have shown that, in some years, some of the richest people in America paid zero, literally zero, in federal income tax. This isn't about illegal tax evasion. Nope. This is about using the existing rules of the game to win.
So, how on earth is this possible? I mean, if you earn a salary, you're probably paying around 25%, maybe more, in taxes before that money even hits your bank account. For the ultra-wealthy, that rate can effectively be zero. The big difference isn't about how much they have, it's about how they get their money.
And this right here, this is the fundamental secret. The U.S. tax system is built to tax income, the money you actively earn from a job. It is not designed to tax wealth, the value of the stuff you own, as it grows over time. That one distinction changes everything.
This brings us to the core strategy. It's a three-step process that honestly sounds a little grim, but it is brilliantly effective at preserving wealth. It's called buy, borrow, die. So here's the high-level view. First, they buy things that grow in value. Think stocks, real estate, art. Second, they borrow money against those growing assets to pay for their lifestyle. And third, well, the die part is the final and frankly most shocking step that legally erases the tax bill forever.
Okay, let's start with buy. Imagine you buy a stock for $1, and it grows to $1,000. You don't actually owe any tax on that $999 gain until you sell it. That's called an unrealized gain. The super rich get this, so they just don't sell. They simply hold on to their assets as they skyrocket in value.
Which brings us to borrow. You're probably thinking, okay, but how do they pay for their yachts and mansions if they never sell anything? Simple. They take out super low-interest loans using their massive stock portfolios as collateral. And here's the absolute key. The IRS does not consider a loan to be income, so it's millions, sometimes billions, of completely tax-free cash.
And this isn't just a theory. It's all documented. Elon Musk has used his Tesla stock to get personal loans. Jeff Bezos has done the same thing with his Amazon shares. Oracle's Larry Ellison reportedly secured a credit line of over $10 billion backed by his stock. They live these incredible, lavish lifestyles on tax-free borrowed money.
And now for the final, most audacious step, die. When a wealthy person passes away, a little-known tax rule called the stepped-up basis kicks in. What this means is the government essentially pretends the original purchase price never existed. The value gets stepped up to whatever it was worth on the day they died. So all those decades of untaxed gains, they're just wiped clean, erased. Their heirs can sell the assets the very next day and pay zero capital gains tax. It's wild. Now, as powerful as this whole strategy is with stocks, real estate is where it gets put on steroids. The same principles apply, but with even more powerful tools at your disposal. See, with real estate, you get this really strange paradox. While your actual property is going up in value, the IRS lets you pretend it's going down in value on paper for tax purposes. This magical concept is called depreciation. Let's just look at a quick example. Say you have a rental property bringing in $24,000 a year in cash. Through depreciation, you might get a paper deduction of over 14 grand. That deduction, plus other things like mortgage interest, can often reduce your taxable income to zero, even while you're collecting actual cash every single month. And it gets even better. There's a powerful tool called a 1031 exchange. This lets an investor sell a property, take all the profits, and roll them directly into a new, bigger property without paying a single dollar in capital gains tax. You can just keep doing this over and over again, trading up forever and kicking that tax can down the road indefinitely. It's like hitting the upgrade button on your wealth without ever having to cash out.
So what does all this mean? Well, it means there are basically two different tax systems in this country. One for people who earn wages and a completely different one for people who own assets. When you earn a W-2 salary, your money is taxed at the highest rates with almost zero flexibility. The government takes its cut before you even touch it. But for an investor, money comes from capital gains, which are taxed less, or from loans, which aren't taxed at all. And you have this whole arsenal of deductions and deferrals you can use. It's a totally different world. So why is the tax code over 75,000 pages long? Well, here's the other side of the secret. It's not just for collecting taxes.
Most of those pages are actually about creating incentives for behaviors the government wants to encourage. Things like investing in businesses, creating housing, and generating jobs. The wealthy haven't broken the rules. They've just learned how to read the rulebook the government itself wrote.
Okay, so you don't have to be a billionaire to start using these principles. Let's talk about 3 practical moves you can start making to play a different game.
The goal here is pretty simple. Shift your mindset from being just a wage earner to being an owner, even on a small scale. You can do this by, first, using the accounts the government literally designed to help you build wealth. Second, creating a small business to unlock new deductions. And third, owning an asset that gives you those investor-level tax benefits. First things first, max out your tax-advantaged accounts. Money in a Roth IRA grows and comes out completely tax-free in retirement. A 401k lets your money grow without being taxed today. And an HSA is like the holy grail. Your contributions are tax-deductible, it grows tax-free, and your withdrawals are tax-free for medical stuff. It's amazing. Second, start a legitimate side business. The second you do, a portion of expenses you're already paying for, your internet, your phone, part of your car usage, can become legal business deductions. That lowers your overall taxable income from your main job.
And third, think about buying a single rental property. You don't need a huge portfolio. Just one property immediately gives you access to the power of depreciation, mortgage interest deductions, and all the other perks that real estate investors use to build serious wealth.
So, when you boil it all down, the takeaway is this. The tax system was never designed to be fair. It was designed as a set of rules and incentives. And the people who take the time to actually learn those rules are the ones who come out way ahead.
It's not about cheating the system. It's about understanding it. All of this information is out there, pretty much hidden in plain sight. So the real question is, are you ready to learn the rules of the game?